Are you still holding cash? The ship has sailed. There's a 30% chance the US will fall into civil war in the next 5 to 10 years. We're finished. We're about to collapse. The years of low prices are over. Many people are going to lose a lot of money this time. What you are going to discover in this video today will save you a lot of money. Currently, many things are happening in the world economy. World trade, which rarely shrinks, is shrinking now. This usually only happens during pandemics, recessions, or major economic downturns like the Great Depression. For a while now, there have been signs suggesting a pandemic might come, especially the indicators that are good at predicting bad times early, but it hasn't started yet. That doesn't mean the warnings were wrong or that a pandemic won't happen. It just means it's taking longer than many thought it would. And now those same warning signs are getting worse day by day.
It's never too late to turn things around. You are the only obstacle.
We'll start with how the system works. The system is a great equalizer, wiping out a lot of debts and starting fresh with new power. The United States established a global order after World War II, having 80% of the world's gold and the strongest military, including nuclear weapons. This led to the American World Order, where leaders gathered in Bretton Woods to set global rules. This order promotes peace and prosperity, as no one challenges the dominant power. People are tired of war and want peace, which stabilizes the world. However, prosperity leads to increased debt and wealth gaps, creating inequality and limiting opportunity. As other countries recover and rise, competition grows, challenging the United States' unique position. The winning country also gains the world's reserve currency, used for international transactions. This cycle repeats because people react predictably to similar circumstances, causing economic downturns like the Great Depression in the 1930s. Dave Ramsey has stated,
"You must gain control over your money or the lack of it will forever control you."
By understanding the predictability of the people, he highlights and emphasizes that we should start preparing for the economic cycles to avoid the same fate as our ancestors. Many people are unaware or haven't thought much about it because they don't think it affects them. This is becoming increasingly serious, and it appears we're reaching a critical point. Let's look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing since. We believe it's now around or below 3% year over year, which doesn't leave much room for growth or inflation unless the money turnover rate increases significantly. But we're not seeing the rate pick up. If anything, individuals and businesses are spending less freely. Moreover, M2 peaked in March and has seen sequential declines in money, which is uncommon. We haven't surpassed that March peak again, and we might not. The way FED policy is going, it seems they're making a mistake. For those of you who don't know, M2 is how the US government guesses how much money there is. It counts all the cash people have, and all the money in checking accounts, savings accounts, and short-term savings like CDs. Chairman Volcker managed to control inflation, which had been building up for 15 years, starting in 1964 with the Vietnam War and the Great Society programs. During those 15 years, both fiscal and monetary policies went unchecked, leading to significant inflationary pressures. Even during events like the Arab oil embargo, there was never such a significant slowdown in fiscal and monetary policy as we are seeing now. Federal spending is down 14% year over year, something not seen in the 1970s. Back then, monetary policy seemed automatic, leading to the devaluation of the dollar. Volcker's approach was to cut off the money supply and end inflation, a process that took a long time for people to believe it had worked. But this time, inflation isn't a 15-year problem, but only a few months one, caused mainly by unprecedented shocks to the system, such as the global pandemic and supply chain disruptions due to COVID-19 panic. Then came Russia's invasion of Ukraine, which added to these shocks. Unlike in the 1970s, these events didn't embed inflation expectations into the system. Yet Chairman Powell is using a much larger sledgehammer to control inflation, potentially 6 to 10 times larger, depending on the FED's actions. Dave Ramsey often emphasizes the importance of understanding economic trends and their impact on personal finance.
Financial peace isn't the acquisition of stuff. It's learning to live on less than you make so you can give money back and have money to invest. You can't win until you do this.
This highlights the significant implications of inflation on individuals and businesses alike. He also warns against excessive spending during times of economic uncertainty, advising people to prioritize saving and avoiding debt. Now let's say, for instance, your financial situation is not good, meaning you spend more money than you make and have little savings. And you have more debt than savings, and you're in a tough spot financially. This is a fact, and if there's a downturn like a widespread economic problem or a significant wealth gap, you're likely to have conflict. These cycles are more than just a coincidence. They're measurable conditions. It is crucial not just to discuss concepts and theories, but also to show specific measures: the wealth gap, the level of debt, the amount of money being printed, and the conflicts arising from these issues. By monitoring these factors, we can better understand and anticipate economic conditions. Yeah, so this is where things get a bit concerning. You see these patterns all through history, repeating in cycles. There are 6 stages of this arc, and the United States is in stage 5, which is a time for major internal conflict. When there's a huge wealth gap, it often leads to civil unrest, and that rings true today. The increasing disparity leads to populism and internal conflict, and historically, this is when a rising power makes its move.
Where you are today is the sum of every choice you've ever made. If you don't like where you are, start making different choices.
Dave Ramsey often talks about 3 big forces to watch. Are you earning more than you're spending? Are you getting along with each other? Or is there internal conflict? And is there a rising power on the world stage? When you see these 3 things happening, you can see where we are in the cycle. Right now, we're spending more than we're earning and creating a lot of debt. This leads to inflation and higher interest rates, which makes the wealth gap worse. The internal conflict is also increasing, and we're seeing a lot of political polarization. And there's the rise of China and Russia, which changes the geopolitical landscape. We need to talk about inflation. But first, the thing that got me to pay attention to this was how far into stage 5 we are. There's a 30% chance the US will fall into civil war in the next 5 to 10 years, and a major conflict with China at 35%. Do you think those numbers roughly hold? And how do we slow this down? If you ask me, I'd say those numbers are probably a bit higher now, and things are progressing a bit quicker. The US is still ahead in the ability to influence the world with economic sanctions, and that's a big asset. And if that isn't powerful, then that's a problem, because others will perceive our weakness. Right now, we're in a capital war with Russia and a trade and technology war with China. We're not in a shooting war with China, but we're providing military support to Ukraine. We're fighting these wars with economics as a weapon, which is risky because it could threaten the value of the dollar. In terms of how this will happen, I'd say there are 3 big questions to ask. First, do Putin and Russia win or lose? If Russia controls eastern Ukraine and their economy isn't too badly hurt, that's a win for them. But if the US and Europe are still ahead in the ability to influence the world, that's a big asset. Chairman Volcker faced double-digit interest rates, raising them from 10 to 20%. While this was a significant increase, it wasn't comparable to today's situation with Chairman Powell and the Fed. Today we've seen rates move from 0.25 to 5%, a much steeper rise. Some say the starting point was low, but that makes the current increase even more dramatic. This perspective is crucial in understanding the current situation. Ramsey points out that we've been in a low-interest environment since the 2008 crisis, and expectations of inflation were not built into the system until now. This shift has serious financial implications. Ramsey warns,
"You can't be in debt and win. It doesn't work."
We've already seen some of these consequences, but many Americans are not aware of them or haven't considered them carefully. In the UK, there was a near financial system collapse due to liability-driven investing in pension funds. Ramsey often emphasizes the importance of preparing for the unexpected, saying,
"Act according to your wage or act your wage."
The assumption that interest rates would stay low indefinitely led to risky derivative activities. When rates unexpectedly increased, pension funds couldn't meet their obligations, and banks faced collapse. The crisis isn't just a UK issue. If the Fed continues to raise rates, we'll likely see similar crises elsewhere. Pension funds and banks are now forced to sell off assets, creating further market instability. In times like these, you must gain control over your money or the lack of it will forever control you. Inflation is a critical issue, and in the past, people used to joke about burying their money in the backyard to keep it safe from inflation. However, many people learned that this is not a wise strategy and a thing to joke about. So what can you do in an inflationary environment if you're not an investor? The first step is to understand that holding on to cash and debt assets is not a good idea. Many people think cash is a safe investment because it doesn't fluctuate much, but they fail to consider inflation. Inflation has recently been around 8.5%, and holding cash with minimal interest rates means losing 8.5% of your buying power. This understanding is slowly changing, and people are realizing they should focus on maintaining their buying power, not just the number of dollars they have. People believe cash is trash when it comes to long-term investments. Instead of holding on to cash, it's better to invest in a diversified portfolio of assets. Diversification includes having assets that are inflation hedge prone, such as inflation index bonds, which adjust returns to account for inflation. These could be assets like gold, precious metals, and inflation index bonds. And let me tell you, you're better off owning inflation index bonds than regular bonds in an inflationary environment. Understanding where to put your money called strategic asset allocation is important. It means building a mix of things to reduce risk, but keep your returns high. Ramsey has the opinion that lots of people lose in the market because they buy when prices are high, sell when they're low, and get too excited.
Contentment may be the most powerful financial principle. You can give more, avoid debt, and live better.
In the United States, corporations are collecting a lot of debt. This is largely due to pressure from short-term shareholders who prioritize stock buybacks and dividends, even if it means taking on more debt. This trend is particularly concerning in sectors like retail, which are facing both cyclical and long-term disruptions. Dave Ramsey often warns about the dangers of debt accumulation.
Debt is dumb and cash is king.
He highlights the importance of businesses being debt-free and financially stable. This philosophy is directly relevant when examining the current situation where companies are leveraging up to satisfy short-term demands, potentially jeopardizing their long-term financial health. For instance, Nike, a major retailer, saw its inventories rise by a significant 44%. This is indicative of broader issues within the retail sector, where high inventories may force companies to slash prices to clear shelves. Ramsey's advice underscores the risks associated with over-leveraging, cautioning that it can lead to deflationary pressures and impact consumer spending negatively. Looking back at economic trends, inflation tends to come down during strong economic periods due to increased productivity. This contrasts sharply with the current scenario, where the economy is being challenged by high debt and weakening consumer demand, suggesting potential risks of deflation. What I believe is crucial is to apply our decision-making principles and see how they would have worked in the past. This gives us some insight into what we might expect in the future. It's important to strategize and operate accordingly. I'd say the most important steps are actually the simplest ones, like establishing a solid asset allocation mix, rather than getting caught up in risky day trading ventures. Regarding economic cycles, it's essential to acknowledge that every global reserve currency has eventually collapsed and been placed. It's amateur to assume that the US dollar's dominance will last indefinitely. So what can we do to reduce internal conflicts and ensure stability? We need to focus on increasing productivity and fostering equal opportunities. As Ramsey emphasizes,
money is 80% behavior, 20% head knowledge. It's what you do, not what you know.
Creating a stable economic system requires earning more than we spend as a society. This means boosting productivity and ensuring equal opportunities for all. Achieving this involves investing in education and infrastructure, which are often undervalued but incredibly impactful. Furthermore, Ramsey stresses the importance of bipartisan collaboration to address societal challenges effectively. By bringing together smart individuals from both ends of the political spectrum, we can devise sustainable solutions. This reflects promoting a culture of cooperation and compromise while investing in foundational elements like education and infrastructure. By prioritizing these principles and working together, we can build a stronger and flexible society. Wrapping up, go watch this video where I explain in details how to turn a mere $50 into $20,000 in passive income. Don't forget to subscribe to our channel to stay updated with our latest videos. If you found the information useful, please share this video with your friends and family so they can benefit too. Just don't forget to hit the bell icon to get notified when we post new videos. Until next time, take care, and thank you for being part of our community.